Remember how gold prices shot up to 55,600 levels after the Russia-Ukraine war broke out? But then it came down again to 47,000 levels right after central banks started fighting inflation with a series of aggressive rate hikes and withdrawal of liquidity. Now this shows that gold prices have been highly volatile in the recent months. What's the reason for that? It's the change in the macroeconomic scenario. Now we all know that gold is one of the key vehicles of investment, especially if one is looking to diversify their portfolio. So if you're planning to buy gold now, we're here to help you navigate the space and understand what makes gold prices move. But before that, don't forget to subscribe to Money Control YouTube channel and like and share this video. The most critical price determinant is demand. Let's look at this more closely. Global jewelry demand stands at about 2,230 tons, which is nearly 47% of the total supply. While this is a major demand component, it has little bearing on gold prices because jewelry demand is discretionary and driven by marriages, festivities, and gifting. While these indicators do have a meaningful impact on prices, it is largely in the short term. In the longer term, we believe changes in the overall level of confidence in the monetary system and the economy drive gold prices. Therefore, to analyze gold over the long term, it needs to be seen as a monetary asset rather than a commodity. Meanwhile, total investment in bars and coins is about 1,000 tons, which is 21% of the supply. However, speculative positioning and institutional investment can determine sentiment and serve as a swing factor which can drive prices. Now, this demand is usually based on the current macroeconomic scenario, influenced by factors like the yield on the US 10-year Treasury, inflation-protected securities or TIPS as we know it, dollar strength and the US 10-year 2-year nominal bond yield spread. The 10-year 2-year spread is widely tracked as an indicator of recession. A positive 1-year TIPS yield increases the opportunity cost for holding gold as gold is a non-yielding asset, while a negative TIPS yield will entail inflows into gold because of gold's capital protection characteristic. Similarly, a stronger dollar makes gold expensive. Now this causes the flight of money out of gold, thereby impacting prices. Therefore, when the yield curve is inverted, there's usually a flow of money into gold to tide over economic uncertainty. Supply is equally important when it comes to gold prices. Mining and exploration is an ongoing process and there's limited fluctuation in mine production as the costs involved are very high. That's why even during the 2020 lockdown, when gold demand fell significantly, mine production remained stable at 3,476 tons. Recycling supply, on the other hand, is a reaction to gold price moves. When gold prices increase, people tend to sell their gold to cash in on the profits or ease their financial crunch. Therefore, although supply is one of the drivers, its impact usually wanes as the situation stabilizes. Banks are an important part of the economy given that they create capital and provide liquidity. A healthy banking sector indicates a healthy economy. Now, we found that the banking sector shows strong inverse correlation with gold prices. Whenever the banking sector has suffered, it has had a positive impact on gold prices as investors prepared for economic weakness. The health of the banking sector is therefore a leading indicator of gold prices. Check out the banking index in this chart that has given a floor to the gold price. If the health of the banking sector weakens further, we can expect a spike in gold prices going forward. Now, similarly, credit spreads are also an early indicator of risk and thereby impact gold price movement. We considered a ratio of low US bond yields to high US bond yields. When credit spreads widen, it indicates investors are moving towards low-yield debt to protect capital from risk. According to this chart, spikes in gold prices have been preceded by larger credit spreads, and currently we can see a widening of credit spreads, which is expected to benefit gold prices going forward. In the current scenario, indicators hint at more upside in gold prices. Now, why is that? Both corporate and government debt has risen post-COVID. Governments are struggling with rising deficits and unsustainable debt, and corporates are staring at higher interest rates. Like I mentioned earlier, in such times, investors prepare themselves for economic weaknesses. Therefore, experts have been recommending some allocation to gold to effectively diversify capital.